Let's do some MCQs on consolidation. Question number 1. In the context of consolidated financial statements, which of the following statements about non-controlling interest is correct? Okay, so the answer is A. Now, when you are doing theoretical MCQs in other topics also, you should know why other three options are wrong. Okay, because then only you can really identify why A is the answer. Let's see B. They say non-controlling interest is recorded as a liability. I told you it's not a liability. It's what? Under equity. C. Non-controlling interest does not impact the consolidated income statement. No, I told you it affects both. In balance sheet also you write, in income statement also you write under profit, you have to tell how much goes to non-controlling, how much goes to parent. Non-controlling interest represents the total value of all subsidiary companies owned. No, it is not representing any total value uh, of all subsidiaries company. Okay, so that is only the value of the amount of shares which are not owned by the parent. Okay, not the all the amount, not the total value, right? So what is the best answer here? It is presented in the equity section of consolidated balance sheet, representing the portion of subsidiary which is not owned by the parent. Clear? And see, this is from where you can make your notes also. Examiner can ask you define non-controlling interest. So this is the answer. Best answer, concise answer. You see? So let's do another question, number 2. They say Penco owns 90% of the voting stock of Spenny. After consolidated financial statements have been prepared, the entries to eliminate intercompany payable and receivables will. So my friends, the answer of question number 2 is D. The answer of question number 2 is D. D for dog. Uh, as I discussed with you, when there are intercompany transactions which we will eliminate, that process is done while we are doing consolidation. Okay, I mean to say, if you remember my Excel file, I told you that when we are creating this consolidation worksheet, okay, so here we will, okay, let me do one more thing to make it easy for you. Okay, this is the point where you will do this adjustment here. So you have the balance sheet of A, you have balance sheet of B. When you are merging them, you will say 1000 plus 500 like that. And then there will be adjustment, minus or plus, whatever, in this column to reach to the next column, which is consolidated balance sheet. You understand? This adjustment column, there is no double entry here for intercompany transactions I am talking about, which we cancel out. Like if there is a receivable of A, in A asset, it is written receivable from B. In B's balance sheet, in the liability, it is written payable to A. We need to remove it, right? In this column, which I have just highlighted for you, but there will be no double entry of this. What double entry? If you will make double entry, it means you are going to A accounts and you are removing the receivable. How we can remove the receivable? There is a receivable, right? In B account, you are removing the payable. How you can remove? We cannot remove. It's there. But to do consolidation, we are just removing it because otherwise it will overstate the balances and presentation will not be good. You understand? So the answer is what? The answer is D. It will not be reflected in the accounts of either company. It is only an adjustment which you will do to create the consolidated accounts. Clear? Question number 3. In a business combination, the identifiable assets of the acquired company. Acquired company means B in our examples, and the liabilities assumed are to be recorded on the books of the acquiring company. Acquiring company means A in our example. At what? This question you can solve with my discussion of goodwill when I did with you. Remember? So I told you that we cannot acquire on the basis of book value. We have to see the fair value. Remember? That will only result in either goodwill or gain on bargain purchase. Remember? So what is the answer? B. Fair values. Clear, everyone? Okay, we have a short calculation question, like a basic question you can expect in exam. They say, what is the amount of goodwill to be recorded by the company related to the purchase of the target company? Company acquired 100% of the net assets of our target company for $900 cash. The target company balance sheet is below, right? So if you see this balance sheet below, you, just now we did a question, right? In which you said we will look at what? We will look at the fair value. And in my example before, remember I was telling you, we need to see what are the assets, we need to see what are the liabilities, and we remove assets minus liabilities to get something called net assets. Asset minus liability is what? Net asset. So in consolidation, most of the times they use the word fair value of net assets. This is what they call it. Okay, so the heading is fair value and my assets are 900, my liability 200. So what is the fair value of my net assets? How much? Fair value of net assets, how much? Hmm? How much? My friends, I told you what is net assets. Net assets means assets minus liability. So 900 minus 200, how much? 700. And how much we paid them? More, right? We paid them premium. So this is goodwill or this is gain on bargain purchase? Goodwill. How much goodwill? Very nice. So what is the answer? See, option A, they are writing in negative. Negative is not the answer because there is goodwill. Positive. If the figure is positive, it's goodwill. Figure negative means gain on bargain purchase. Clear? So the answer of this question is C, $200. Clear, everyone? Okay. Let's do another question similar to this question, which is question number 5. Exam technique, first read the requirement. They say the amount of goodwill or gain on bargain purchase resulting from this purchase, if any, would be how much? So the company purchased 100% of the shares of other company for $600,000. So what do you think? First of all, what do you need to do to get the goodwill? What you need to do? You need to calculate fair value of net assets. So the book value column is irrelevant for you. The fair value column is relevant for you. $600,000 is called fair value of consideration paid. Just for your information, I'm telling you. What is $600,000? Fair value of consideration paid. This is the money you are paying to acquire another company. The net assets, the fair value of net assets of the other company are how much? 850 minus 350, which is 500. So 600 minus 500 is how much? $100,000 goodwill. C is the answer, my friends. Let's do another question. Tell me.
Sir, why they are giving common stock and
This is additional information. In MCQ, they can give you a lot of irrelevant information also, right? This you see from other topics also. So, like one of the topics in your course is regression analysis, which we did. So in that lecture, if you will go in MCQs of regression, you see they give too much information and only we need one item to solve the question. This is what they are making sure that you can do it in exam. If you cannot do in exam, how you will do in your office? I told you before also.
because this they are showing common stock book value 150 and fair value is also 150. Whereas in inventory we have fair value total only 100.
Why you are comparing common stock with inventory? What is the relationship of common stock with inventory? Common stock and inventory, totally different things. We need fair value of assets, fair value of liabilities. To get fair value of net assets, equity irrelevant. By the way, tell me what is fair value of net assets? What do you mean by net assets? Net assets means equity. Net assets means what? So to get the fair value of equity, we need fair value of assets one by one, fair value of liabilities. Then only you can get fair value of equity. You understand? But we don't call it fair value of equity. We call it what? Question number 6. Financial statements of an investor and an investee should be consolidated. Again, see, they give you one more terminology. Like in the Excel file, if you remember, I gave you two terminologies. You can add there. Investor, investee. So they can keep giving you different terminologies, but you need to remember like that. Okay. So try question number 6. The answer for question number 6 is what? A. Remember we discussed this company is financially controlled by another company, even if you don't have majority voting interest, right? So still you will do consolidation. It's okay. It's not only about voting interest, right? B, C, and B, C are clearly wrong. They say non-controlling interest, they have more than 50% shares or they have substantive participating. This is not, no consolidation can be done if this is the situation, right? And it does not depend on the industry. I mean, this is a nonsense option that if all the companies are in the same industry, this does not give you the right to do consolidation. Okay, you need to have control, you need to have substantial power over the other company. Okay. Question number 7. Which one of the following statement about variable interest entities, remember we discussed, is correct? So now that activity will help you in which you Understood. What is variable interest entity? Let's see. My friends, the answer for question number 7 is C. Variable interest entity, if you remember, we discussed, it's not about voting power. It's about two things. Remember, I told you two things, A, B. The power to direct the activities. And then the second thing is you have to absorb the losses and benefits. Remember? So they say that, and the terminology which we studied is also, they were calling it primary beneficiary. Though the company who has the power to direct and to absorb the losses and benefits is called what? Primary beneficiary. So they say the primary beneficiary of VIE is required to consolidate financial statement with its own, regardless of the ownership. Yes, it does not matter you hold more than 50%. Okay. So C is the answer. Why A is not the answer? They say it is a legal entity that is financially controlled by a single company. This is wrong because it is controlled by two or more companies, not a single company. That's why A is wrong. B, company can be considered primary beneficiary if it only has the obligation to absorb. This is wrong. Why? Because there were two requirements, not only one. Okay. Because what's the other thing? You have power to direct. That's why B is wrong. Okay. And D, they are talking about primary beneficiary, definition of a parent in consolidation exclude. This is also wrong. Okay. So by the way, I will also provide you the answers of these questions. So you can go there if you have any confusion. Okay. And notes also, which I showed you before. When preparing consolidated financial statements, the entity being accounted for is what? Yeah. What do you think? See, when we do consolidation, we are assuming it's one company. So that one company, legally speaking, it's not one company, it's so many companies, right? Maybe 3, 4 companies, 10 companies. They are all having different legal presence, legal existence. Okay. So when the entity being accounted for means, what is this consolidated entity? Is it legal entity? No. Is it parent? No, because parent has a separate identity. I told you when consolidation is done, it is done by parent. But in the parent annual report, we show two statements. First, the consolidated statement, and then parent will show their own statement also separately. Getting it? Now, when the parent will show consolidated statement, this is not parent itself. This is all the companies together. I told you, right? So this is called economic entity. What is this? Economic entity. So the answer of this question is question number 9. Which of the following is not a characteristic of the voting interest model for determining a controlling financial interest in a subsidiary that would require consolidation of the subsidiary's financial statements with those of the parent? The answer for question number 9 is A. Okay. See what they say. Very simple. I mean, this was a simple question. They said consolidation is required when parent own majority voting interest, even if a subsidiary operate under foreign restrictions that limit parent control. So you see, you have a limitation. You're not controlling the entity. So what we discussed, remember, if you are not able to control, even if you have 99% ownership, still you cannot consolidate. Because the main thing is not ownership. The main thing is what? Control. And here they say you don't control. There is a limitation on your control. So this is the answer very clearly. You got the point, everyone? Why the other three are not the answer? This is very simple. You can read later on in the official answers, which I will share with you. Question number 10. In the process of preparing consolidated financial statements, which one of the following item does not need to be eliminated? My friends, very simple question. Remember we talked about intra-company transaction, which you will eliminate. So requirement A, they're saying gain on sale of asset to subsidiary. Eliminate. B, dividend receivable from subsidiary. Eliminate. C, profit in inventory acquired from parent. Eliminate. Because this is intra-company. What about D? Profit on inventory sold to non-affiliate. Non-affiliate means it's not your group company. External company. So definitely D is the answer. Very simple question. I think the most easiest question till now was this one. They said not need to be eliminated. So it's very clear that option D is correct. 11. The purpose of consolidated financial statements is to present the financial position and the results of operations of a parent company and the subsidiaries as if the group is a single company. You can add here the word single economic company. Economic, that is the main word. To accomplish this goal, the financial statements of the majority owned subsidiaries must be what? My friends, the answer for question number 11 is A. Right? They should be consolidated if the investor company has a controlling financial interest. This is the main point. We need to have control, right? Then only consolidation is okay. And the other three options you can see when I will share with you the answers, so you can read through. Okay. 12. MNO purchased all of the company's 100,000 outstanding common shares for $40 per share. Okay, so we own 100% of this company. On that date, okay, first of all, this sentence can give you fair value of consideration. That how much you paid? How much you paid? 400,000 or 4 million?
4
4
million.
million. 4 million. This is called fair value of consideration paid. Now, what is the next thing we need? By the way, exam technique is first read the requirement. We missed it. The amount that should be reported on MNO consolidated balance sheet for goodwill is, it means we need goodwill. So first thing we have it now, 4 million. Now, what is the second thing we need? Fair value of net assets, right? On that date, the company's balance sheet showed total assets of 5 million and total liabilities of 2 million. Is this relevant for us? Huh? They say on this date, the XYZ company, which is acquired, the balance sheet showed this value. We need this value or we need fair value? So this 5 million and 2 million, I don't care about it. What I need is the next thing. They say the fair value of the identifiable net assets on that date was how much? 550,000 greater than carrying amount. Now I need to look back to carrying amount also. Carrying amount means what is written in the balance sheet, right? So in the balance sheet, how much is my net asset? 5 minus 2, which is 3. 3 million is my net asset in the balance sheet. They say the fair value is 550,000 more. It means now what is my fair value of net asset? 3,550,000. You understand, everyone? 3,550,000 minus 4 million. How much? Clear, everyone? So how much premium I paid over 3,550,000? 450,000, right? Because we paid 4 million and the fair value of net assets were 3. Let me write here for you. Fair value of consideration is how much? 4 million, right? Fair value of net assets is 3,550,000. How we got this? We said 5 million, right? Minus 2 million plus, because they said it is more by 550 or over the carrying amount. So this is the working for 3,550. And this is the goodwill because you paid extra. So the goodwill is how much? 450, and the answer is C. I hope it's clear, right? So my friends, these are some questions we did on consolidation, and this is the maximum they can ask you on this topic. Okay, and this is more than enough we have done on this topic.